JP Morgan just announced a string of mutual fund to ETF conversions earlier this month. That follows a pattern of similar conversions earlier this year, including Guinness Atkinson in March, Dimensional Funds in June. As more funds are choosing to shed the mutual fund moniker and embrace the ETF model instead. So what are the biggest factors driving this sudden rise of actively managed ETFs, and will we see this trend continue into 2022? Brian, is this a matter of tax efficiency? Is this a matter of fee potential? What are some of the key drivers here?
Well, we think investors are looking to get exposure to the markets through a number of different vehicles. So whether it's mutual funds, separately managed accounts, or exchange traded funds. Certainly, the ETF does offer some features to investors, the ability to trade throughout the day. In the instance of these strategies that we will be converting pending board approval in the early part of next year, these will be 100% transparent strategies. And at the point of conversion, we actually will also be lowering the overall expense ratios on these portfolios. And so we do think that there's a client behavior point to be made here as well. If you look at 40 Act assets, so mutual fund and ETF across the U.S., now 25% of those assets are invested in exchange traded funds. 88% of financial advisors across the U.S. use ETFs in their portfolios. And so, we're just being really thoughtful. We're being very client focused as far as what our plans are. But we have announced the intention to convert these 4 mutual fund strategies into ETFs pending board approval in the early part of next year. And we think that this is a good outcome for investors for all the reasons that we mentioned. The benefits of active management delivered through the ETF vehicle, which offers a lot of features for investors. We think it's a win-win.
Todd, what do you think this means for the mutual fund product? I mean, Brian made a really good case as to why this conversion is necessary and beneficial for clients. What does that do to mutual funds?
Well, we're seeing investors rotating away from actively managed equity mutual funds and rotating either to index-based equity ETFs, which they've been doing for years, or actively managed ETFs, actively managed equity ETFs in particular. They're punching above their weight this year. They've got about 9% of the overall flows to the equity space, as opposed to just 2% of the assets. And we're seeing it in a couple of different ways. We're seeing firms that are new entering the ETF market, like a firm like Horizon Kinetics that launched an inflationary beneficiary ETF, INFL. That's been very popular, launched this year and is over $600 million in assets. We're seeing firms that are doing semi-transparent structures. Fidelity launched in a Magellan version of semi-transparent version of Magellan. And then we've got the fully transparent products like Brian's talking about with JP Morgan. And we've got a couple others that are lined up. Federated announced their plans to be launching ETFs probably in 2022. And we're waiting on Capital Group, which has said they're going to be coming to market with actively managed equity ETFs in 2022. So those are some big players entering into the ETF marketplace and shifting away from their only focus on mutual funds.
Now, it's interesting, Todd, just to follow up on that, it sounds almost like an oxymoron, active ETF, because historically we've thought of ETFs as this kind of passive product. How frequently are these active managers trading with ARK, which is kind of the most well-known example, perhaps, of an active ETF strategy? They're trading quite frequently. Is that the same to be expected for a lot of the names that you just mentioned?
So, right, ARK is doing things where they're fully transparent and there's discretionary and there's trades happening every day that they're buying and selling based on what's happening in the market and what's happening to some of their favorite stocks. These strategies, like what JP Morgan has launched and plans to convert, as well as what we expect from American funds, what it currently exists from Fidelity, these are more buy and hold longer-term investment strategies. So there isn't as much risk in front running because of the nature of the investment strategy, moderate turnover. So the manager can still make the trades they want to, but they can react to the marketplace. We have big news today with the Pfizer vaccine that is likely causing active managers to make discretionary decisions that you wouldn't find within a S&P 500 index-based ETF.
Huh. It's all so fascinating and definitely something we should be watching, especially given the amount of assets that are flowing into these categories.